Good day everyone and welcome to the premium video newsletter for July 11th, 2013. Stocks rallied strongly today after Federal Reserve Chairman Ben Bernanke said the central bank is in no hurry to stop supporting the economy after the closing bell yesterday. Bernanke said the U.S. economy still needed help because unemployment remains high and inflation is below the Fed's target. The Fed is currently buying $85 billion of bonds a month to keep interest rates low and to encourage spending and hiring. The comments were the Fed's latest efforts to reassure investors that it won't end its stimuli before it's sure the economy is strong enough. Both stocks and bonds fell sharply on June 19th after Bernanke laid out a potential timetable for Feds to start winding down its bond buying program. However, this time around, he seems to be going backwards to reassure investors that nothing is going to happen anytime soon. The U.S. stock indexes are all hovering near the high levels, and based on the confidence that Bernanke is giving the country, it would appear that we have more to go. I hate to say this, but it looks like the Feds are completely controlling the U.S. economy at this time, and they're doing everything possible to artificially improve the outlook for the stock market. Just look at the statement made by an economist yesterday. It sums it up pretty well. Quote, "In one short sweet statement, Federal Reserve Chairman Bernanke has flicked a switch on the markets." End of quote. Technically, volume is beginning to pick up and the market has no difficulty breaking the 1661 level or the 1674 level. The next technical level we once again are faced with are the previous highs that were made on the 22nd of May. The level that we need to break to take out the high is 1687, and unless drastically negative earnings come out, it looks like the market is headed straight up to that resistance level. The RSI indicator on the S&P 500 is currently a bit above the 70 level, which is considered the danger zone. Once we get into the 80 level, the market is grossly overbought. So we're not there yet. Based on current outlook, it appears we'll be hitting the old high, but I have strong reservations about going higher, unless earnings are very strong. Right now, we are coming out close to expectations, so I'm not seeing anything too miraculous as far as earnings are concerned. The Department of Labor said the number of people filing for initial jobless benefits last week rose by 16,000 to a seasonally adjusted 360,000, compared to expectations for a drop of 4,000 to 340,000. This caused the US dollar to trade lower in today's trading. Technically, I'm anticipating the dollar to continue moving lower, especially in light of the employment situation. Remember, the more help the Feds are giving the US, the less confidence they are implicating in the U.S. economy, which will cause the dollar to move lower. I was anticipating a lower move earlier last week, but I was about 48 hours early. Based on technicals, the dollar already touched the 82.5 level, and the next level down from here is the 81.5 level. And if everything stays the same, I don't see us moving down to these levels in the next few weeks. Ultimately, I feel we will go down to the 80.5 level if we continue seeing weak unemployment numbers and continued reassurances from Bernanke. However, I believe this will happen slower than expected. In government bond trading, the yield on the 10-year note fell to 2.59% from 2.63% Wednesday, and mortgage rates are now at 4.51%, which is a 2-year high. The futures contract finally rallied as expected and moved above the 126 level. The next level where we should see some hesitation is a bit above the 127 level. There's a strong resistance around this area, and I'm still very bearish on the bond market in the long term. I'm only looking for a good place to initiate my short position, and if the downtrend continues, as it should, we should only rally for a few more sessions in the best case scenario. In commodity trading, the price of oil fell from a 16-month high, dropping 83 cents to about 1.5 a barrel. Technically, the market looks like it's topped out short term. This is typical in a reversal pattern, but knowing the fundamentals behind this market, I'm going to need some confirmation to make sure this rally is in fact over. The price of gold rose for the fourth straight day, climbing $35 or 2.8% to the 1283 level. Yesterday, I alerted everyone to a short-term triangle pattern, and we had a breakout from that pattern today. I'm not anticipating a strong or a very long-term move here, only above the 1300 level, so I can short this market at a reasonably high level before it really tanks. In spite of today's gains in the Australian dollar, we expect the Aussie to decline long-term due to bearish interest rate differential expectations, along with increasing evidence that the economic slowdown in China will in fact persist. I was anticipating a range-bound choppy market with more consolidation, and this is exactly what this market is doing, which is not unexpected after a strong trending move. There's a setup today, and it's another tail gap to the short side. For the stock is QEP, and the stock is a leading independent natural gas and oil exploration and production company. The trade is a channel trade. Usually, tail gaps are taken in a direction of the major trend. However, this stock is not trending right now and is range-bound in a Y channel. I will place a sell stop at $29.65, and if filled, I will place a buy stop, a protective buy stop, at $30.50. This is a low-risk channel trade where the profit target is around the $27 area. That's it for today, and I will update you tomorrow after the opening. Have a great night, everyone.